Jay Martin here, CEO of Cambridge House, and I am joined now by Ross Beaty, the chairman of Pan American Silver, chairman of Equinox Gold, founder of the Sitka Foundation, recipient of the Order of Canada, among many other things. Ross, it's good to have you back.
Thank you very much. Happy to be here.
So I thought a good place to start would be to follow up on a comment you made on our stage in Vancouver a year ago, last January 2020. And you were discussing the gold market. And at that point in time, your perspective was that we were maybe in what you would call the fourth inning of the secular gold bull market. And just given the year we've had since January, I want to start there and see, has your perspective changed and have the goalposts moved?
Well, it has changed a little bit. I mean, if I was bullish a year ago, I'm super bullish right now. It's been a crazy year, and everything that's happened, I think, has accentuated the bull case for gold. And so I mean, if it was the fourth inning a year ago, it's no greater than the fourth inning now, or the actual game is going to go into extra innings. And I just don't know how long it's going to go, how high it's going to go, but for sure, we are not at the end of the party. And every single thing every government in the world is doing right now to stimulate their economies is positive for gold. It's negative for currencies. It's positive for gold. It's negative for bonds. It's positive for gold. All the geopolitical stuff that's going on, all the mayhem and chaos that's happening in the U.S., all of that's good for gold. So, I don't know what exact part of the game we're in, but I just know we're going to go longer and stronger, and by no means is $2,000 gold the record we had in July. By no means is that going to be the all-time high. I think we're going to blow through it this year at some point, and beyond that, who knows how high it's going to go.
Okay, interesting. Now, yeah, I mean, all those macro factors you pointed out, we're all watching, right? And it's like this perfect storm for the gold price. However, recently there's been some chaos in events that typically would drive a rally in gold, and the opposite happened. You've been through enough cycles, you're probably not even bothered by that. But for anybody who's watching the price thinking, what's going on here?
What happens today is people get overwhelmed with noise. I mean, there's noise. People are glued to their screens and glued to the media feeds that they get so much more of than they used to. So they're kind of so short-term focused that they don't step back and look at the forest for the trees.
Right.
So I think the best thing to do is to step back and think about what actually is happening in the entire world right now with respect to paper money, with respect to global debt, with respect to inflation prospects, and things that typically drive gold and will continue to drive gold. And it's not just the run in Bitcoin that's negative for gold. That's to me, that's noise. I don't see Bitcoin as a replacement for gold. That kind of thing is just people that are glued to screens and look at things, analyze things too much. Step back, look at what's happening in the world, look what's happening to gold supply. It's very important, of course. Supply is just as important as demand, and look at short-term, long-term trends. So, and I think when you do that, you're going to end up being as bullish as I am. You just can't avoid it, I think.
Got it. Okay, now actually, follow-up question to that then. If we see this market continue to heat up, as like the noise is just going to continue, on either side, right? A gold correction, you get extra noise, but a gold rally, you get just as much, and almost more dangerous noise because it comes in the form of promotions that don't deserve your time, but they look really great when they hit your desk. So what kind of advice do you have for retail investors, Ross, or what common mistakes have you seen retail investors make in a budding resource bull market?
The thing about bull markets is the tide comes in, it lifts all ships. So, you get a lot of money pouring into the space. We saw that in 2020, a huge amount of money, a lot of financings were done, and the investors typically don't separate the wheat from the chaff. So they'll buy crappy companies. Those companies will blow up, and they get embittered to the whole sector. So investors should always look at quality. They always have to look at the quality of the project, the quality of the management team, the game plan, how well management sticks to its plan, opportunities to make a big outsized return, and not so much the slick promotion that the promoters are making. Go behind that and look at the underpinnings of the company before they really step in too much, because boy, good promoters can easily part people from their money without necessarily having the quality that's behind them that makes those stocks actually perform over the medium and long term. So in a bull market, that's a danger. But at the same time, I have to say also, no matter what you buy that's got gold in it, is going to go up if the gold price blows through $2,000, let's say, again this year. The whole sector will do well, whether you buy large caps, mid caps, or juniors. They're all going to do quite well. Of course, the better investors are going to do better because they have more ability to analyze good companies and separate them from bad companies.
So for somebody who works 40, 50 hours a week and they only have a small amount of time to do that kind of diligence, are there any hacks when you talk about the underpinnings behind the curtain? Should they find a guru they should follow or focus on just the people? Or what's one or two simple, actionable pieces of advice?
Yeah, I think, getting a good broker is good. A good broker from a good firm, number one. Number two, looking at newsletter writers. Some of them are really good. Some aren't so good. Some are really good. And look at the record and pick one. Go to conferences, go to virtual conferences or real conferences like yours. And those are all good things for investors to do. It doesn't take a huge amount of time, but it really gets them knowledgeable about the space and able to actually invest in a more, I would say, a more scientific way or a more sensible way. Now, underpinning that is the reality, however, that in today's world, it's a very different place than it was 10 years ago. It's much more difficult to get large pools of investment capital to go into the juniors. So it's just a more challenging time for juniors. A lot more money is following the ETFs, the robot investors, the algorithmic investing that's going on. So none of that has to do with real value. None of those are using classic quantitative analysis to get into, or qualitative analysis to understand the value of companies. And this means, a lot of that's just dumb money. So what I've tried to do is build my most recent company, Equinox Gold, for that market where you get value for getting bigger per se. You get more liquidity, that brings in new investor pools. And it doesn't necessarily bring it in pools that actually look at the underpinnings of the quality of the company, the earnings, the cash flow, and so on. But that's also important, of course. So when you get when you have the ability to analyze or get advice from people who are good analysts, it's a very important thing to do in this space. It always was and it remains today, even though there's less people doing it.
Okay, last question on investment strategy just came to mind. A lot of the guests we have on this show talk about the money flow as it enters the resource sector. Starts at the top, starts with the big cap producers, the stable bets, right? And then works its way down as the market matures until the final stages where the juniors get hit. And, I was talking to Nolan Watson. He has the opposite approach. And he's like, no, you go to the juniors first. They're the riskiest in a mature market. When the resource market begins to crash, they'll get wiped out first. Companies with real assets, that's the safer bet. And so he has the exact opposite approach. Do you have any thoughts on that, Ross? Do you think about it that way?
He's very much, Nolan's a smart guy. He's absolutely right. It's all about your risk acceptance, right? It's true. The equation is risk reward. That's the ratio. And you want to try to have lower risk, higher reward if you possibly can. But at the end of the day, if you have a low risk tolerance, you buy the low risk, large cap stocks that are going to do less well, but they're safer. They're more diversified. They have more liquidity. You can get in, you can get out easily. And thus they're just safer bets. The real money, though, especially when a bull market gets going, the real massive money comes from the juniors. It's the high risk, high reward stuff. And if you take a long view on gold, and you're right, that is the best place to go in terms of your performance. But you have to be diversified because those juniors, they can blow up regardless of the gold price. You can have a bunch of drill holes that just don't work. Everything's right except they don't find gold. and so the stock doesn't do well. So you've got to have a diversified approach in that sense. But Nolan's correct if you have that risk tolerance.
And I feel like the best insurance policy against that junior risk is betting on the CEOs with that track record of success, because they'll have optionality, right? And if they miss on those holes, they'll have a plan B, plan C.
Totally. It's a trite thing to say, but you've got to bet on people.
Yeah.
At the end of the day, people are important, but even idiots can find mines if they get lucky. And there is a lot of luck in this business, and even criminals can, if they're in the game. Every blue moon, criminals find big mines and make a ton of money. So you can't be too clever just in betting on people. You've actually got to look at the quality of the project, where it is, other factors that affect value.
Okay, I'm with you. on that note, I want to talk about Equinox for a second. Talk to us just about the strategy, Ross. Why was the goal to become America's premier gold producer?
It kind of just landed in our lap. We ended up with this project in California and a project in Brazil. Then we got something in Mexico, and we just decided, you know what? Let's just tell people we're building a relatively safe company. We're not going to be in flaky places in Africa. We're not going to be in strange places, Papua New Guinea, parts of Asia. Certainly not the CIS countries. And so let's just go to places that we can fly to easily. We can eat the food, drink the water, don't have to worry about getting things stolen from us. And we're in Canada, U.S., Mexico, and Brazil as a result. Right. I would say it has become the plan. It didn't start out that way.
I feel like there's two factors driving that now. And obviously you want to go to stable jurisdictions where you can trust the government's not going to pull any, tax issues on you, or worst case scenario, nationalize something. But in addition, investors are more conscious about source country, right? So there's both the government risk, but also the ethical conversation that's thankfully more and more, occurring more and more frequently these days. And do you expect that to continue? I mean, ESG is in its own bull market, which is a great thing, right?
Yeah, no, it's going to continue. It's just good business to do all this stuff, and it's great that investors are actually valuing companies for their focus on environment, social, and governance. It's fantastic. It's long overdue. Yeah, and there's all manner of I could make a long rant about investors that actually don't really understand what they're doing when they're looking at ESG. It's quite a complicated area, but it's generally speaking, the better governed companies are going to do better. The companies that look after environment and social aspects are going to do better. It's just goes straight to the bottom line, and thus it goes to fundamental value and share price performance. It's good business. Right. And it's easier to handle those things for sure in countries that respect those things as well. So, if you invest in a company that's working in say Canada, you can be fairly sure that they're looking after those things pretty well. If you're investing in a company that's working in, let's say, Kazakhstan, or maybe a number of other countries I could name easily, the odds are they're actually not going to be having very good governance, because those countries don't have very good governance. They're not really going to have to worry too much about the environment, because the countries don't require that. And social issues are dealt with in those countries by strong people doing nasty things to weak people. That's the traditions, and that's what happens. So you probably aren't going to have to worry too much about the social side either. Having said all of that, the reality is everywhere in the world, every single country in the world, every region, every village, they all have smartphones. They all have access to what's happening in the entire world. They connect to environmental and social NGOs in the world, who then take up the torch of those people with Canadian and American companies, like immediately. So you can't get away with things you might have been able to get away with 10 or 15 years ago, simply because there's instantaneous communication. If, for example, we have a tailing spill or anything for that matter, an accident, whether it's actually damaging or not, instantaneously somebody has taken a picture of that, put it up online, and everybody in the world who has a beef against companies or that particular company or its management, they have input. And they put up on social media whatever they want to say about it. So it's something you have to deal with. And it's not always right. People always have to be careful what they read. There's a lot of truly, false news out there that is put up either by naivety, ignorance, or maliciousness. And people have to sort that out as well. And remember, you simply cannot believe everything you read, particularly on blogs. All this garbage that gets put up on blogs by people who have agendas that are different. You've just got to remember that's one person's opinion, or it's one person's rhetoric. It doesn't mean it's true. That's the world we live in today. You've just got to be able to filter that stuff. And yet it's a reality for companies. They've got to be far more transparent, far more honest about what's happening. And if they're not, they're going to be held to it.
I love it. And, you put your money where your mouth is. Last we spoke, you shared that your ambition for the next stage of your life is to give away all the money you've made, and you're focusing on environmental causes, right? Yeah, for sure. It's super, super inspiring, Ross. So I want to pivot to the silver market a little bit. top performing commodity in 2021. You've described silver as the schizophrenic metal with one foot in precious metals, one foot in base metals. So some interesting trends. I mean, historically, silver demand has only been about 10% investment driven, 90% industrial. The investment appetite's massively increased in 2020. Do you think that's going to continue, Ross? And what are the main driving forces of silver, you think, in 2021?
Yeah, I mean, silver did really well in 2020. It was undersold, and it was very easy to make a case for silver going up. It has this schizophrenic attitude. It doesn't know where it stands, either industrial metal or precious metal. But last year was a world of precious metals, and so because gold went up, silver followed, and actually outperformed gold. It just had a great year. And don't forget, silver is a much smaller market than gold. It's 1/10 the size of the gold market. So a little money sloshing into this business or out of it will make an outsized performance either way. And last year was a bull market, so silver did really, really well. It also did well, by the way, on the industrial side. Silver demand last year, industrial demand went up because a lot of silver is used in photovoltaic cells, for example, notwithstanding the fact that the world economies were in turmoil last year. Silver is the most conductive metal of heat and electricity, and therefore it's used in all digital products. And so every time we have, a lot of people said, oh, silver's finished. 25 years ago when I first started Pan American Silver, silver's finished because, its biggest uses in photography, and photography is dying as traditional silver halide photography in favor of digital photography. Well, how wrong they were. It's true, silver use in traditional photography is gone, but silver use in digital everything goes up crazy. For example, every electric car uses more silver than regular cars because there's so many more things that need electricity in an electric car. And you could say that all the way through the chain of digital products. So silver's got all these amazing industrial uses, and the big one now from nowhere 10 years ago has been photovoltaic cells. So it's a great metal, and I would say a lot of these uses are silver price insensitive. So just because the price of silver doubles, you don't change your demand that much. You're still going to have these enlarged demand. So it's got long-term great legs in terms of its industrial demand, and as a precious metal, it's got great legs to the extent that we have a bull market in gold, and silver's going to follow as poor man's gold.
Okay. Yeah. And you touched on the size of the market, 1/10 that of the gold market. It's like 800 million ounces were produced in 2020. It's, collectively, what is it? 22 billion. That's half of Barrick's market cap alone. Yeah. And you mentioned some of the driving forces now with the Democrats in the US controlling the Senate. Biden's pushing forward his $400 billion clean energy stimulus plan. Yep. So there's going to be a ton of activity with the size of the market, Ross. Do you expect a supply squeeze, like a significant one, or what are your thoughts?
Yeah, I mean, the supply side is going to catch up with demand. It always does, but it does take longer these days. And this is bullish for all metals, not just gold and silver, all metals. The reality is it's harder to build mines. It's harder to get social license, longer to get approvals, government approvals. It's just a more difficult business today. And so it takes, from discovery to development, maybe 20 years now, where it was only maybe 10 years ago. And this is going to slow down the supply response. So you're going to see prices stay higher longer than normal. Okay. We're seeing that all over the place. We saw that a month ago when the Pebble deposit in Alaska was shut down. You can't guarantee development just because you find a deposit these days. It takes a lot longer. It's much more difficult. There's more people with more money, more entitlement, fighting mines that get built anywhere in the world. That's the world we live in. It's good for metal prices, though.
Yeah. Okay. Well, we can't have this conversation without talking about copper. And we're sitting at 7-year highs, I think. Ross, has the price gotten ahead of itself, or have we not seen anything yet? Or what are your thoughts on copper moving forward?
Yeah, no, the price is fundamentally based. Copper has fabulous legs. It's a wonderful demand-supply balance right now. You have tremendous demand from all things electrical, all things energy. It's an energy metal as much as lithium is, because it's used in electricity generation, transmission, and end use. And we're getting more electrical as a world. We're getting off fossil fuels in both generation and transportation use and other uses, because we're trying to improve our climate. and reduce global warming. So that's very, very good for copper. And you're seeing that in the price today. You're also seeing the reflation trade, right? You're seeing world economies that'll start to pick up again in 2021. China was the driver of this last year. China just drove copper demand because it's regrowing. And I think you're going to see more of that now with all the stimulus that's happening in Europe and the United States and Canada. You're going to see more fundamental demand for things like copper, not just copper, but lots of other metals. But I have to say, of all the base metals, I am most bullish on copper, and I'm certainly not alone in that opinion.
No, you're not. Okay. Back to the junior miners for a second here. You know, I think we referenced the recent transaction, Equinox purchasing Premier, and giving you a property in Canada, completing the Americas, right? Do you expect more M&A? And I guess I'm asking this on the back of our inability to travel for the last 12 months in a market that's heating up. Typically, I think we would have seen more. And so I'm wondering if there's some pent up demand you think will be released once we can get on airplanes again and do property.
Oh, for sure. I mean, it's actually a good question. Definitely there is pent up demand, and definitely companies were not able to do M&A last year like they might have wanted to. Simply because, I mean, we've got a project, for example, Lumina Gold. We're trying to sell that. It's in Ecuador, and Ecuador's been locked down. And companies, and even if it wasn't locked down, companies in say China or the United States or wherever have had, or Canada, have had problems flying there, doing their due diligence. The companies just don't allow it. They just don't allow travel. So you can't buy a company unless you've actually touched the ground and you know, seen the reality of what you're looking at. So for sure there has been a slowdown of that kind of thing. And I think that will pick up in 2021 as everyone gets the jab and we have a return to normal. But at the same time, there is a restraint happening, and it's been going on now for 5 or 6 years, really since the blowout of 2014, 2015, when companies that had done deals, larger companies especially that had done deals in sort of 2011, 2012, even 2013, they were just castigated because they blew so much money on dumb deals.
Right.
And they lost huge amounts of shareholder wealth, and shareholders fought back and said, you know what, we're not going to let you do this again. We want to return to shareholders. We want normal metrics. You've seen all the stuff that VRIC's doing with Mark Bristow's management. You know, he's trying to run that as sort of a business that could compare with other businesses. I don't understand that personally. I think gold is so different and so special and is unique to just about everything. I don't know. I don't particularly support that management strategy, but at the same time, a lot of investors have wanted return of capital, and they've wanted companies to pay dividends instead of doing acquisitions, especially larger companies. So whether that changes or not, I don't know. I think there's a lot of discipline in those companies, and they're run by more conservative people. Right. They're directed by shareholders who want return of capital. They don't have the growth obsession, and we're fighting that a little bit in Equinox Gold, because I happen to think that in that particular company with that particular set of dynamics, the growth model is a very good one because it creates wealth per se. You've got a higher multiple. And as you got a higher multiple, the bigger you are, the more that translates to value. So there is a point at which that changes. And I would say we're getting very close to that point right now in Equinox, because we now have the critical mass, we have the internal growth. We don't need to go and raise more money. We don't have to go and do more deals. We've actually got that scale right now. So from now on, I just don't see the need for us to be doing that too much longer. We'll do internal growth. We'll demonstrate value. Shareholders love that. And I think, just watch what we do there in terms of development of our existing assets. So it sort of depends on the kind of company. On the whole, though, 2021 should be, just to sort of sum up, because I could go on for a while on that. I think 2020, you're going to see more deals than in 2020, but there's still going to be some restraint. And I don't think we'll see many mega deals that we saw a few years ago.
Okay, got it. So final question for you. I mean, you touched on the competency of management today versus 2013, 14. You expand that to company valuations, health of the balance sheets. Is it safe? Would you say the market is in a better place than it's been in a decade?
Oh, it's for sure been in a better place. I mean, again, it depends on what metal you're looking at. If you're a coal company, I wouldn't say yes. It's a pretty
Okay.
terrible nut new business. But if you're a gold company and a silver company, which I guess is really what your question was.
Correct.
Oh yeah, I mean at $1,800, $1,900 gold producers are making buckets of money. The costs are usually around $1,000 an ounce, and they're making they selling it for $1,000 or $800 margin. They're repairing their balance sheets. They're increasing their dividends. Their valuations are going up. They're in really good shape right now. And of course, that typically has meant a lot of indiscipline in the past, where they use all that cash flow and they start buying companies to get bigger because there's more glory and ego in bigger companies. And that has been one of the problems in the past. So we'll see what happens now. And smaller companies have been able to finance. There's lots and lots of risk capital out there, and so. One of the symbols of sort of the late innings gold game is when, small companies that might have been able to sensibly raise $3 million to fund a drilling program somewhere, for example, they raised $30 million. And when that happens, then you can say, okay, we're getting real close to the top of the market. We're not there now for sure. We were there maybe a little bit last July, but it closed fairly quickly, and we'll see. That's definitely the sign of wobbly kind of. It may not be the ultimate top, but it's going to be maybe a cyclical or a intracyclical top that will be followed by some intracyclical or say head fake bear market. But
that's a good indicator to look out for. That makes sense.
Indicator.
Yeah. Okay. Well, helpful. Look, Ross, thanks so much for coming back on, and thanks for your time. It's been great reconnecting with you.
My pleasure.